Welcome to this walkthrough of the commercial real estate valuation model from efinancialmodels.com. This model is a revised version of the previous model. It's a bit more detailed and a bit more comprehensive. So let's dive into it and let me show you the highlights of this model. The way this model is structured is that we have here different tabs. We have one executive summary tab, one tab which summarizes the rent roll and the leasable spaces. Then we have one tab which summarizes the cash flows at the property level and with the aim to build a DCF valuation. Then we have another tab which summarizes financial statements from a potential buyer point of view. We have another tab which basically does a calculation for the replacement value of this property. And then in the premium version of this model, we do have a PowerPoint tab which basically outputs different tables which can be basically copy pasted into a valuation report template. So how does this model work? The way this model works is that we have a property with different tenants and different leasable spaces. And what we do first is we need to work through our rent roll and determine what is the annual rent, which is currently contracted. And let me first scroll here a bit to the left to start the right place of this model. So you see here we have a list of leasable spaces. We have the gross floor area. We have the leasable area. If you like to have this in square meters instead of square foots, we can simply go here to the assumption section, change the model from square foot to square meter, and then we are set. In this case, I change it back because the example is made on square foot. So we have here the rent roll. We have here then the rental prices, which if it's currently rented, we enter the price as it is. If not, we put in the best estimate what price this will rent. If it's rented, then we also input here the lease duration, from which date to which date this is currently leased, and we just take a conservative view. We just enter the end date of the contractually signed lease. And then what we do here is we plot this on a monthly schedule of the contracted rent. This is starting from the date of the acquisition. And then we summarize this here on the annual schedule. Hold on, that's here. Here's the annual schedule, and you can see that the contracted rent then normally runs out and basically stops. So this means we can draw a chart, and we can basically see this is all the rent we have currently in the vault, or we have currently secured, and the average lease term is about 4.5 years for this property. So this means when we estimate the rental income, what we're going to do then is we estimate with the assumptions down here our rent roll. We say in general, we expect a yearly lease escalation of X%. We expect this occupancy rate. Then we basically build a forecasted rent roll, which first takes into account the secured rent, but then basically projects expected rent based on occupancy and an inflation adjustment. And doing all this will lead us to a yearly summary of the expected rent roll. And this gives us then the table here with a forecast, what do we expect in terms of getting rent from this building. And when we compare this chart from this chart, we can see that all the cash flows which here are up here and here they are down. This means we will need to work, and we'll have to secure by working with our tenants, either getting them to prolong their leases or bringing in new tenants so that we can achieve our lease objective. And this also tells us a bit how risky it is. If you have one tenant which is in there for 10 or 20 years with a good creditworthiness, it's less risky. If you have everything rented short term, it's a bit more risky, because then all the risk is on you and you will have to make sure that your rent is well to achieve this rental income. What's then happening is we start building our DCF valuation. Here is the summarized version. If we go to the more detailed version, you can see here that we built the rental income. Here it's separated what is contracted and which part is projected. Then we also will want to look what are the costs of operating this property. In terms of estimating costs, we go here to the assumption section, and we have two types of costs. One is recoverable expenses. These are costs which you can charge to your tenants and you get the money back. So what's happening, let's go here. What's happening here is you expense these costs, but you also will get them back. So basically they net themselves out and they are zero. More important for a property owner are the costs which he has to carry. And for that we have here assumptions where we enter which costs we expect to be carried. If you can simply overwrite the labels here or set the cost to zero to adjust it to your property as you like and as it makes most sense. And what you will end up with is the net operating income, which then basically is projected here. And in order to get to the unlevered cash flows of the property, we need to deduct the capital expenditures and tenant improvement expenses. Here, the way this is forecasted is we have two groups of CAPEX. One is the initial CAPEX, because normally when there is a handover or an acquisition, normally the new buyer will first spend some money on renovating to make the building, to put the building in best leasable shape. So you'll have to spend some money upfront and then afterwards some money to maintain the building. And we have here these assumptions go into a fixed asset schedule where you can basically calculate when these CAPEX occurs, and then these are the CAPEX cash flows which go into the DCF valuation above. And then we are pretty close. We are now here we have built net operating income, we deduct capital expenditures, we have the unlevered cash flow before exit. This is a cash flow before taxes, so that's why it's stated here. And then what we can do is, if sometimes we prefer to model this with a 10-year forecast, as this model structure is, but if you prefer, let's say, to forecast only for 5 years, you can simply change it here. And then the cash flows will stop at year 5 and your exit will move forward to the year 5. And this exit value is basically estimated by the exit gross cap rate, which is applied to your rental income. So if we can go here, you can see how this formula works. Actually, it should be rental income, that should be here. Voila. So just corrected this, and then we deduct, basically we sum up all the forecasted free cash flows, and when we got the DCF value of the property. So what can we do next? We run our DCF valuation. It resulted in this value, 34.6 million. Then what we want to do, first step, is to compare the result of the DCF value with the replacement value. For this, we have here a model where we can estimate or set all the parameters to determine the replacement value. You will find the calculations here. This part is more detailed, and this part on the right is more the condensed version that you can see which are the components, and you will have to adjust this until it makes sense and applies to your situation. And then the point is that you have this chart here where you can compare, and you'll need to think about the question why either replacement value is higher or lower than the DCF value. Does this make sense or not? So this type of analysis helps you to figure this out. Then another section is the basically sensitivity tables. Here this is not updated because normally it takes a lot of time to update this. So what I do here is I've set it here calculation options to calculate automatic except for data table. Now if I want to update it, I set update and then I run it. I press once enter and you see now it's calculated through. But if I press enter again, it will basically slow down the model. So what I do is once it's updated, I set it back so I can work a bit faster with this model. And now the point of this sensitivity analysis is that we want to study what's the impact of any change of the key assumptions on the DCF valuation result. And for this we vary one of the parameters either up or down and want to see the impact on the valuation. And here you can see that which parameters are most important. We run a sensitivity analysis on all these parameters and you can see that the average lease rate is the most important. Is the most important one, has the most, any change here has the most impact on the building's value. So this is a useful analysis to understand the risk a bit better for, and also the explanatory power of the DCF analysis. What we also want to do is we want to have a look, how does our valuation look like if we would have a buyer who wants to buy into this building at the suggested DCF valuation. So what will happen is he will have to pay the value to the seller of the purchase price. Here we have an option to adjust if needed, but here we keep it at 100% of the DCF value. Then there are transaction costs the buyer will have to carry. The initial CAPEX is deducted inside here, but he will have to finance it here. So from his point of view, it's cost because he will have to incur costs to acquire these three parts. So this gives him all-in acquisition costs, which is a bit higher than the DCF value, which is 37.2 million in this case. Then we have here a model where we can study what's the amount of debt financing a buyer can obtain. This is done quite simple. All we do is we say what's the loan to value ratio, and basically we calculate, in this case 65%, this commercial building of the purchase price. If your bank would calculate this differently, you can simply change the formula and apply it as it makes most sense. And then what we also have here is a small debt schedule where we can basically see how our debt balance will develop and will look like. In this case, I will set back the forecast period back from 5 to 10 years. I personally like longer forecast periods. So let's have a look how this looks like. So this means our debt balance starts with 23 million, which is 65% of the DCF value of the property. There's some debt amortized here, 2.5% of the initial amount per year. This goes on until exit at year 10, and then at year 10 you have to repay all the debt at this buyer's exit. So that's how the calculation is to be understood. And what we then want to figure out is, if you look from a buyer point of view, so he gets the unlevered cash flows of the building based on our revenue and our cost estimates. Those are the unlevered cash flows. Then if he uses the type of leverage which we think he can get, we have to deduct, he will have to pay the interest expenses, he will have to pay taxes. So now we are talking in an after-tax, we're switching into an after-tax mode. And also he will be a bit punished because the bank will ask him to amortize the building. So he will also have, in terms of a cash perspective, we need to make sure that he is still cash positive, otherwise it will hurt him and he might have a difficulty buying into our proposed valuation. So this line would be good if this is positive. And then all we want to do is we want to figure out what are his yields. So when we lever it with debt financing, we can push up the yields. You see here from 4.2, we can basically push it up. And then let's say 12.8. This is basically after interest, and the reason why it's 12.8 is because now we don't compare it to the all-in costs. Now we talk only about the equity part, which benefits hugely from the debt financing and leverage he can get. Ergo, his yields will start quite high. And then what we do is we check what's the impact if he has to pay taxes. So his yields drop at the end from 12.8 to 9.6. If he also has to pay the regular amortization, then the yields drop further to 5.8. And in this model, you see the further the model goes, the better the yields are. This you will need to study if that's realistic or not, but the point is that you should calculate this and try to find out what the buyer's point of view is. And then we also want to see what would be his exit value, and we can calculate for each of these cash flow stream if we look at it unlevered, what's the amount to invest, what are the profits a buyer can make, what's the multiple here, what's the IRR on this cash flow stream, what happens if we lever it, and then what happens if we look at it including all the amortization. We have to look at what will be the yield and also what will be the IRR of a potential buyer. So this helps us a bit to better make sense out of our DCF valuation and get a bit a better feel if that's realistic or not. So I hope this walkthrough was useful, and I would appreciate if you leave your comments or give me a thumbs up for this video. This model I also include a link to this model below in the description below. It's available on our website, and I hope it will help you quite a bit in your next real estate analysis. Thank you for watching.